Hi, everybody. Welcome to the Patti Brennan Show. Whether you have $20 or $20 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. So those of you who have been listening and tuning in over the years know that at the beginning of the year, we usually do an economic outlook. That's usually done with Brad Everett and I. And then at the end of the year, we kind of hold ourselves accountable and say, okay, this is what we thought was going to happen, what actually did happen. Today, I thought it might be fun to do a mid-year outlook, a mid-year accountability check. And for that, I've invited Sam Baez. So let me kind of frame this for you. So we refer to Eric Furman as the professor. When he takes on a subject, he goes deep and detailed. He's Mr. Historian as well. Brad, on the other hand, he's a brainiac. He is brilliant and has a way of taking something really, really complicated and summarizing it in maybe a sentence or two, and then he nails it. Sam is the best of both worlds. He goes deep. For example, for today's podcast, this young father has prepared 14 pages in the form of a white paper, taking time away from his family over the last couple of weeks to prepare for this podcast today. I'm excited to share the information with you. I hope you are as well. Get a pen and paper and be ready. And for the inside scoop, we refer to Sam as Mr. Relatable because everybody loves Sam. He's got a Hollywood smile that you're about to see. He's so smart. He cares so much, and he brings that personal element of love to everything that he does. An unusual introduction, but there you have it. Sam, thank you for everything that you did to prepare for today. Welcome to the show.
Thank you, Patti. Thank you so much for having me. Thank you for your incredibly kind words. I'm humbled by it. Thank you.
You betcha. So here is the question, and the topic of our podcast, this mid-year review, is what happened to the recession? Everybody was predicting a recession. It's interesting because I was just reminded that I wasn't so sure we were going to have one this year, but we'll put that aside. So the experts were talking about this looming recession. Why don't we just kind of get to the basics? And first, for the people who are listening and watching, what is a recession?
A recession is traditionally defined as 2 consecutive quarters of negative GDP. So what does that mean? That means the economy is slowing down. People aren't buying as much. Companies aren't producing as much. People aren't hiring. If anything, oftentimes they're laying off to try and cut costs. So it's a slowing down of the overall economy. If that happens 2 quarters consecutively, traditionally we're in a recession.
Got it. So, and, kind of, again, keeping it with the basics, because we are 70% consumer-based economy, one person's expense is another person's income.
Correct.
And it's the velocity of money, it's the exchange of dollars that makes this thing work so well. So, okay, so one of the things that we've talked about many times before, as we think about real financial planning, real wealth management, can we avoid the recession? Can we kind of position things so that people aren't hurt if the economy does go through a couple of negative periods?
Sure. It's a great question, and I think it really is. It's such a personal question because a recession it's going to be different for everybody. Like I said earlier, layoffs often come with recessions, but not everybody gets laid off during a recession. So preparations or what need to be done for somebody who was laid off is different than somebody who was able to maintain employment. As far as where portfolios are concerned, I think the disconnect more often than not is market performance and portfolio performance very seldom moves in line with where the economy is moving. The market is what's referred to as more of a leading indicator. So the market tends to go down or up before the economy booms or bust. So it's kind of telling us, hey, this is where the economy is headed. So market prices head in that direction to let us know what may be coming down the pike. So
And isn't it fair to say that the market isn't always right?
The market is not always right.
How about it?
The
Okay,
market is not always right. Yeah.
so the market was down last year. Okay, a lot of people, including some of the other components of the leading economic indicators, suggested that, oh, yeah, we're going to have a recession in 2023. No doubt about it. And by the way, I'm just going to say it now. I may say it again and again and again. The goal for everybody listening and everybody watching, our goal is not to avoid a recession. It is to endure it. And we're going to give you some tips. Stay tuned to the end of this podcast. Sam and I have some ideas on how you can prepare and endure whatever might be around the corner. So, you talked about leading economic indicators. Can you explain to everybody what they are and what that really means?
Sure. So the leading economic indicators, the Economic Conference Board has 3 indexes that they look at. There's leading, current, or coincident. I say current because it's easier to remember, and lagging. So leading are all those indicators that kind of point to where the economy is going. It's made up of 10 components. Right now, a lot of those leading indicators are, especially for the past month and the past 6 months, are trending downward. The only one that's pointing up has been the market. The market has performed well year to date. So some of these components are new orders. So new orders, whether companies are ordering inventory, if they're getting more inventory. If companies are not ordering large amounts of inventory, they're not expecting large sales. So that's a leading indicator that these companies, for the next quarter or 2 quarters, are expecting things to slow down. In addition to that, new housing permits, new builds. A lot of construction companies, and I'm sure we're going to go into this in a little bit, but a lot of the pain we felt last year had so much to do with the cost of capital going up. We have been spoiled for a decade plus of really cheap money. You can do a lot of really cool things with cheap money. I mean, who doesn't want cheap money?
Exactly.
But as soon as that cost starts to really go up, all of a sudden you get handcuffed. Your monthly payments go up. Your ability to borrow goes down. So now your liquidity starts to leave the household and things get tight. So when you look at the leading indicators and you see that credit card balances and credit lines are going up, but people are extending less credit. So that means that credit card balances are going to get maxed out and they can't get more money. If we think back to I don't want to get too much into the weeds, but if we look back to the financial crisis, that was a liquidity issue. That was systemic with the banks. The banks are the lifeblood of our economy, and if we can't get cash, we can't do anything. Again, like you said, 70% consumer-based economy, we love to spend money. And companies love to make things for us to purchase. So when we see those indicators going in the opposite direction, not in a boom cycle, those are the indicators telling us the economy is likely going to follow what these companies are preparing for.
What's interesting is that, okay, so we talked about leading coincident indicators. What's currently happening in the economy, right? It's probably easier to articulate, to figure it out. We've got tons of data, et cetera. And then there's the lagging indicators. The lagging indicators are corporate profitability, the unemployment rate, because at the end of the day, if companies are looking at what they have to tell Wall Street and their profits are down, what are they going to do? They're going to lay people off because that's usually their biggest expense. So that tends to be the last shoe to drop. But by then, most of the damage from a recession has already occurred. So leading indicators are important. They have been signaling a recession for 2023. What's actually been happening?
Yeah, great question. And I think this is the big puzzle, which is currently, even though the leading indicators are suggesting that things are slowing down, they're not really slowing down that much. And we ask ourselves why. Well, it goes right back to that 70% consumer-based economy. That 70% of our economy is being bolstered by low unemployment. And oh, by the way, payments have gone up. We're making more money.
Right.
So if inflation's going up, but we're also getting raises. Social Security got a cost of living adjustment in a range of 8% last year. So even individuals who aren't working necessarily and getting raises, they got their raises as well. through the government program. So it's the expectation that the higher cost of capital was going to really slow down the economy. I do believe that's still going to happen. It's just been pushed out because, we're going to go into this in a little bit. However, some of the industries that are hiring the most were the ones that felt the most pain back in 2020.
So that sort of reminds me of what Liz Ann Saunders from Charles Schwab has been talking about. I remember way back to last year, she talked about the looming recession, and these are my words, not hers, because it hasn't been that dramatic, right? Mm-hmm. She talked about this and has coined the term, to my knowledge, this rolling recession. In other words, some sectors of the economy got hit right away, 2020, pandemic, then 2021, et cetera. So it's kind of been hitting different sectors of the economy at different times instead of all at once. And I thought that was a fascinating analysis. It does feel right to me. Right. And that's why it doesn't feel as dramatic and frankly, even scary. The market was looking at all of those leading indicators last year and said, oh, yeah, we're going to get hit big time. Yet we were not. We have not been because unemployment is still very low. Now, okay, a lot remains to be seen. To your point, the orders, the factory orders is a little worrisome because the next thing that will happen is they'll start having massive layoffs. Yep. We have seen layoffs in the different sectors, but it hasn't been massive across the economy. And so people are still employed. And because of that, they're feeling flush. They've got income. They're paying their bills. They're going out to, Starbucks and, Costco and et cetera. The credit card balances are increasing, though, and the bank balances are decreasing. So there are a few headwinds, aren't there?
Absolutely.
Let's talk more about this idea of rolling recessions and what we mean by that. I loved it when Liz Ann Saunders talked about it. I think that Capital Group did a deep dive and got really specific of which sector got hit first, what got hit next, and then next, and then next. Let's talk about that more. What have we learned?
Gladly. I have to say this was probably some of the most fun I've had doing the research.
Oh, you are a real nerd.
It is. It's amazing when you actually look at the data because we can again read the headlines, get all kinds of information, but the facts are in the data.
Yep.
And it's almost, it makes perfect sense. The more you mentioned Capital Group looked into it, more and more investment managers are subscribing to this rolling recession theory. The more we look into it, the more we realize it makes practical sense. I went back to 2020, starting there, because that's when we officially had the last recession. It was very short, but we did have one.
By the way, can I say something about that? Okay, stay on that thought. Hang tight. But to me, and I don't know about you, I believe, so remember, go back to 2020, we were in a recession. The Federal Reserve came out with their bazooka. The federal government came out with the second bazooka. I believe, don't have anything to give, but I believe when the textbooks come out about the pandemic and the recession and what happened, because again, as we've talked about so many times before, every crisis that we've gone through in America, our leaders have learned, okay? Whether we agree or not, this is not about Democrats or Republicans. We learn and we take a deep breath. They do their debriefing. And I think when they do that this time, I think they're going to look back and say, when we look at lowering interest rates and quantitative easing and the stimulus that was put into this economy, irrespective of income and need, I believe that the textbooks are going to say that it was the stimulus that really saved this economy because it was so much more powerful than any other nation in the world. And guess what? Look at our economy as we compare ourselves to every other nation in the world. We came out of that fantastically. Very short recession, not a huge amount of damage, a lot of wealth creation since. Look at every other country around the world, not so. So that's my theory. Don't know for sure. I think the think tanks will tell us in 5 or 10 years and we'll be reading about it. But that's my theory. So let's go back to this concept of this rolling recession and which industry got hit first and how that has occurred.
Sure. So that's going back to 2020 now. At one point in 2020, we all remember the market lost more than 30%, but it snapped back very quick. Patti, as you mentioned, because of the large amounts of stimulus throughout the year, the S&P ended the year up over 18%. The Nasdaq just shy of 45%.
Jeez.
The Dow Jones just shy of 9.72. So the market did well despite falling 30% in the first quarter. Now, everybody didn't participate in that. I think we all remember the phenomenon of negative oil prices. They were trying to pay us to take oil. That's what negative oil was. ExxonMobil was down 36% in that same year. We weren't driving anywhere. Nobody was flying. There was no need for oil. Oil had their recession in 2020. The airlines, travel and leisure, restaurants, hotels, nobody was going out. We hear about all this revenge spending now, and that's where the prices are going up. But back in 2020, it was non-existent. Maybe closer to the end of the year. But you look at a company like American Airlines, down close to 45% for the year.
That is really interesting. I remember the cruise lines also getting hammered. And I don't know about you, Sam, the last thing that I was going to do is get on some boat and get stranded.
None of us were.
Right?
Yeah,
so that's fascinating. Okay.
And that's, I mean, if you really think, but in that environment, again, we have the global financial crisis, the tech bubble, everything's falling all at once. But in that same environment where American Airlines gets cut in half, Zoom video increases by close to 400% in the same year. Peloton. I don't know how many people have Peloton bikes. I have one that is now a coat rack. Was up 434%.
What's happened to Peloton since, though?
I can't wait to get to that.
Okay. All right. Good deal.
So since, I'll give you this stat. From 2020 till now, as of yesterday's close, the Peloton stock is down 73%.
Wow. That is quite the drawdown.
Over a 3-year period. So those were, and banks as well. Banks didn't do as well in 2020 because there was this fear if all these businesses are shut down, they're not going to pay back the loans that they owe the banks. Individuals, if they're not working, unemployment was close to 15%. So there was stimulus, as you mentioned, so that helped get us through this. If we didn't have that stimulus, there was going to be a lot more defaults on loans, mortgages, all that. So there were industries that did not boom in 2020, even after all the stimulus.
In spite of the overall 18% increase in the Standard & Poor's index.
That's right. If you're just looking at the Standard & Poor's, you would think there was no recession. There was a recession. And for some industries, it was horrible.
It's back to the garden theory, right? You know, you want something blooming all the time. That's the benefit of diversification.
Absolutely.
One thing is dead or dying, another one is going to bloom. That's the key to a successful portfolio management.
Absolutely. And fast forward, go the next year. So this is a rolling recession. Now we're past COVID, and there's this talk of, all right, interest rates are at zero, or they're very low, we're going to need to start bringing these back up. So then all of a sudden, the companies that would be a little more interest sensitive or would be affected by that started to experience their own recession. So companies that did really well last year, like PayPal, that allowed a lot of online payment systems. PayPal was down about 20%. Let me start with the S&P. Let me take a step back. The S&P in 2021 did 28.71%. The Nasdaq, 22.18. Dow Jones, 20.95. Again, you look at those indexes, no recession, right? But look at certain sectors. So I'm sure a lot of folks, and if you were in the market to purchase a house, even now, but even back in 2020 and 2021, you probably weren't having fun dealing with all the bidding wars, 50,000 over asking, waive inspection. It was a wild time. Fast forward to 2021 when we knew rates were going up, Zillow, which they even got into the business of giving individuals cash offers right online. I mean, talk about really, really trying to take advantage of a situation. They were down 50% in 2021. Zoom, the 400 plus or close to 400 performer in 2020, was down 46%.
What I think is interesting about Zoom, Sam, is I don't know about everybody watching and listening to the show, but Zoom has a great business model.
It does.
That seems to have overtaken Microsoft Teams and WebEx and some of the other video programs. So as a business, Zoom seems to be very popular, and yet the stock is way, way down. Again, another kind of takeaway, never confuse a business with its stock.
Absolutely. And I love that you said that, because if you compare those two, Peloton versus Zoom, Peloton's business model, I would say, isn't as good as Zoom's is. From 2020 till now, what we saw was more of a stabilization, a normalization of the price, because from then till now, it's only down less than 3%. So it's kind of come back to earth.
So that's Peloton?
No, that's Zoom.
Zoom.
Peloton
Okay.
is still down 74%. They got to work on that business model.
Yeah, so Zoom has recovered a lot of what it lost by focusing on its business model. Peloton still has some struggles. By the way, yours may be gathering dust. I'm still using mine every day. It's the only way I can keep sane. I just love Allie Love and Robin. They are the best, but I digress.
Yeah, it's great, but I think like a lot of individuals, I couldn't wait to get out. I don't like working out of my house. I need to leave my house to go somewhere else.
You know what's interesting about that, Sam? I need convenience. I need convenient friends. My best friends are in my neighborhood, and I need convenient everything. So I've got the Peloton at the house. I do 20 minutes, bang it out, then I'm off to work.
Wait a second, Patty. I don't live in your neighborhood.
I know. Well, this is true, Sam. This is true. You'll always be my best friend, right?
Excellent.
So, okay, there was a lot of volatility, wasn't there?
Yeah, a lot of volatility.
What's happening now? So if we think about current, who's suffering? What sectors seem to be suffering now?
Ironically, it seems that a lot of the rolling recession, a lot of those sector real downdrafts were 2020, 2021, and 2022. Because 2022, that was tech. It was the darling tech.
That's right.
That was the winner for the past 10 to 12 years. I give you those numbers. Apple down over 26, Microsoft down over 28, Google down over 38, Amazon down close to 50, 49.62, NVIDIA down 50%, Facebook down 64%, Tesla down 65%. Now, I just went down a list of companies that we are exposed to every day. I don't know what everybody else did last year. I did not cancel my Prime delivery. I didn't stop using spreadsheets. And I still Google search everything. So they're still getting activity. It's not like those businesses ceased to exist. It was more of a valuation thing and preparing for, again, an economic slowdown as interest rates went up and the cost of capital started going up. So you could argue that the normalization for the tech side happened last year. The travel and leisure, more oil, all that was 2020. And we even had with the semiconductors, so that's part of tech. We had the supply chain issues. It was such a wild scenario to see brand new cars selling for less than cars that were 2 to 3 years old, because at least they had their chips.
Right.
Some of the brand new cars didn't have the chips. That's not normal, right? So the stock prices reflected that.
And then we fast forward to 2023, and artificial intelligence is all the rage. So a company that, maybe 3 years ago people never heard of, called NVIDIA. What is NVIDIA? Well, guess what? They are the company that is best positioned to take advantage of artificial intelligence, right? So it is fascinating. Some of the political decisions that have been made in terms of the semiconductors and chips and the dependence that we've had overseas, allowing factories to be built here right on the U.S. soil, that's kind of interesting to me. I'm not saying that that's, it's an investment theme or any of that. I just think it's kind of interesting. And sure enough, that particular area of or sector is doing great.
NVIDIA's up 200% year to date.
Right. So fascinating. Okay, so we can talk about that further, but let's talk about people. Let's talk about the consumer because, as we've said, so much is dependent on the consumer. You and I going out and saying, okay, interest rates are 7%. I'm still going to buy that refrigerator. I'm still going to renovate my home. I'm still going to buy a home. Is that happening? Probably on the latter, definitely not. But some of the other things are still happening. So I think it's safe to say that pressure is beginning to build, right? I thought your statistic and your research in terms of who benefited most from the stimulus was off the charts. Why don't you share that with everybody today?
Sure. Yeah, I think back to the theme is where is this recession? And I think some of these points that we're going to go through point to the fact that we're not out of the woods yet because we haven't felt the pressure, as you said, yet. And some of that pressure is, a lot of that pressure is going to be on liquidity. So where was the liquidity from 2020 on? Studies show that a lot of it was with recent grads because they don't have high expenses, they don't have high mortgages, in a lot of cases they don't have children yet. So all that stimulus was really great for them to just spend. They could just spend it. They could just use it. They didn't have to pay their student loans. I hope they were paying their student loans. Mm-hmm. But they didn't have to. So that's extra.
That blows me away. I never would have thought about that, Sam, until you brought it to my attention. And it's so true. Again, they are bodies. They are spenders, right? And so they spent the stimulus money, those $1,400 checks. They got them. They spent them.
They spent them, and they're the ones who they're able to travel. They're able to go around. They don't have a lot of the, I won't say restrictions, but for lack of a better term, the limitations that somebody who has a family, has a home may have. So they were able to really go out there and take advantage of that.
I don't know about you and Sasha. I don't know that you were taking lots of trips and going overseas. I know Michael and Kaylee, my son and daughter-in-law, certainly weren't. I mean, their big trip might have been, into Philadelphia to see a show. That was it. Right. And by the way, guess who babysat, right? So there you have it. So it is a really interesting analysis after the fact in terms of who benefited and how that helped our economy overall. But that's about to change, isn't it?
That's about to change, and it's about to change on so many different levels because it's not just the student loans coming back into the picture. That's in October, they're going to have to start making these payments. And on average, studies say that on average, an individual has a $500 monthly student loan payment. That's not change.
Yeah, that is interesting. That's a lot of money to a recent graduate.
That's a lot.
Now, granted, there might be some who are earning six figures, but these kids are making 60 to on the high side, maybe $80,000 a year. You add that payment to rent, car payments, Thirsty Thursdays, all the stuff that they like to do. That's going to put a crimp in their style.
100%. And to add on top of that, the cost of capital has gone up. What are these recent grads more often than not going to be doing in the next couple of years, maybe in the next couple of months? Buying a house. The cost of buying a house has gone up significantly. So whatever your situation was in 2020, as far as your ability to purchase a house, that same house, even with your same income, even if your income has gone up, costs you significantly more today.
Let's go through an example that you prepared in the white paper. I thought that was fascinating.
Oh, yeah.
And, good news, bad news, incomes have gone up. But guess what? Housing has pretty much remained the same, hasn't it?
It has.
Has it? Housing has not gone down, which is surprising to a lot of people, myself included. So now you couldn't get a house. Now, even if you could get a house, which is actually not necessarily the case either. We still have a real inventory issue. But let's say that you could find a house. Let's use an average in America, average cost of $400 plus, right?
Yeah. So the median home price in the United States is $436,000.
Which I don't know, for those of you who are listening and watching, I would be hard pressed in our area to find a home for that cost, right? That doesn't need a ton of work. You might as well just tear the thing down. But I digress. Let's just look at average over median over American, 436,000.
436,000. We're going to assume a 20% down payment, so that would be $87,200. So you mortgage the rest at 3%. So at 3%, that was back in 2020. You could get a 3% mortgage. You can get a lower mortgage back when rates were at zero. Your monthly payment would be $1,471. That's a 30-year mortgage at 3%. $1,471 a month. That's just principal and interest. So that same house, let's say in 2020, that's the house you wanted. That's what you could afford. Let's say the price of the house did not go up. The only thing that went up was interest rates. So your income's the same, your credit score is the same, nothing has changed at all. At 7%, because that's where rates are right now. I have heard higher, but I wanted to we'll keep it at 7. So 30 years at 7%, your monthly payment goes from about $1,400 to $2,321. That's an $850 difference. Now you add that to the $500 a month student loan payment that's starting back, that's a big headwind. We're talking over $1,300 of a headwind.
And that's all after-tax dollars,
That's
right?
all after
because
tax
the new
dollars.
tax law in 2017, most people are not itemizing, so you don't get the benefit of mortgage interest deductions. So, that's $2,000 of your monthly paycheck that's going to these two items that you didn't have before. So it's an important consideration, and I appreciate you bringing that to all of our attention in terms of a potential headwind going forward. Now, let me just put it in perspective. Let's think about demographics of America. How many people are we talking about? One of the things that we're going to talk more about is recessions tend to be very personal. Not everybody feels it the same way. I just would offer that if there was such an impact with the pandemic, there may be a reverse impact as we move forward with these new headwinds. Fair to say?
Yeah, that's fair to say.
Many people listening remember the days of 14% mortgage rates. So you might be thinking, oh, yeah, well, that's nothing compared to what I had. And truly, I remember refinancing to 7% and feeling like we hit the lottery. So again, everything is relative, but at the same point, we've got this recency bias. It's human nature. We remember 3% mortgages. Just be aware that that could have an impact, not only personally, but on the economy as a whole.
Absolutely. And I would even go further to say maybe the thought would be, or the preparation for this environment is maybe it doesn't stay at 7 or 8, but the chances of it going back to 2 or 3 anytime in the near term is very slim. So,
yeah, and that's the other thing. Everybody's been predicting, haven't they, Sam? They've been saying, rates will probably peak, the federal funds rate peak between 5.25 and 5.35, and then it'll crawl back down again. I don't think so. I think that what we have today is about what we're going to have. Yeah, they might float down a little bit if we get some recessionary pressures. I wouldn't count on it as it relates to your plans and your quality of life and the decisions that you've got to make.
100%.
I think the other thing that you brought out in your white paper, Sam, is the impact of Fitch and Moody's on the bank ratings and what that could do to interest rates.
That's big.
Let's talk about that, because that is not being discussed, and I think that's important for everybody who's listening today who may be looking at making major decisions like, should I buy a home? Should I buy a second home? Et cetera. Let's talk about that. So this is all brand new, right off the press.
Sure, yeah. This began in August, and it reminds me back of 2011 where we avoided or kicked the can down the road where the debt ceiling was concerned, but we got downgraded anyway.
Correct.
Same thing happened here.
Mm-hmm.
So we avoided the issue, but we still got downgraded. And that was the U.S., which, okay, we were kind of expecting that.
We lost our AAA rating,
We
didn't
lost
we?
our AAA
That was
rating.
a bummer.
It was a big bummer. We went from AAA to AA plus, but we're still an A student.
There you go. Love it. All right.
But what happened a week later was Fitch came back and started downgrading banks. And what happens when these credit agencies, when these rating agencies give you a rating, it's like us getting a credit score. The better our credit score, the better our rates on car loans, credit cards, mortgages, all that. However, if our credit score is horrible, it doesn't mean we can't get that stuff. It's just going to cost us a lot more.
Right.
So back to that liquidity crunch, that's more money that's being squeezed out of our pockets or corporations' profits. So with their ratings going down, now banks are it's kind of like a warning to them. And it's saying, hey, no risky loans. We're watching you. So banks are going to take a step back and they're not going to lend as much.
Don't you think that the banking crisis that turned out not to be such a bad crisis earlier in the year may have made the rating agencies a little bit more, let's really look at these people, because they don't want to get blamed, right? They don't want to get blamed and say, oh, you missed this. Look at SVP. Look at, these banks. They went under. They had to be, purchased by stronger entities. So they are, again, nobody wants to get blamed. It's like regulators, whatever. That's a sidebar. But so they are taking a much more cautious outlook, aren't they? And they are already hitting many banks with downgrades.
They're hitting them with downgrades and putting others on what they call review, which means they may be downgraded in the future. And that's including JP Morgan.
Which is the largest banking entity in the country. So 27 banks are on watch or they've already been downgraded. So if I'm on the board of directors of this bank, I'm going to say, hey, guys, we have to increase our liquidity. We have to really be conservative with our lending practices. Forget the interest rates, right? We understand that rates are higher. And typically you think about banks as being more profitable as interest rates go up.
Right.
Now they're getting hit with these downgrades, and it may not be the case. So what's going to happen? They're going to pull money out of the economy, and those people who want to borrow anyway and can borrow and are being offered these loans, you're going to pay more.
Yep.
So that's corporations as well as individuals. Corporations, now their cost of capital, as you refer to it, their ability to get cash is going to cost them more money. What does that affect? That affects their bottom line. So their profitability is going to be affected. Their ability to pay their dividends is going to be affected. Even their ratings are affected. Sam, I love the one statistic you brought out. I couldn't believe it. So yesterday, Sam and I were preparing for this podcast, and Sam said to me, Patti, if you were to get, there are only 2 companies that have a AAA rating that are left. I mean, it used to be everybody wanted to be AAA. That's what you wanted to be, right? Mm-hmm. You got the best loans, the lowest rates. It was almost free money. There are only 2 companies left. Guess which ones they are. Of course, I lost. I didn't guess either one of them.
You got close, Patti. You said IBM.
Yeah, that's true. I said IBM. Well, I'm an IBM baby. So it was Microsoft.
And Johnson & Johnson.
I should have known J&J. J&J is very conservatively well managed, well run. So they're the only ones left that are AAA rated. How about that one?
That's it. And what really surprised me about that information was the number of companies that are considered junk bonds, that are considered high risk. Close to 1/3 of U.S. corporations, 29%, are considered high risk debt. Because these companies issue bonds, banks issue bonds to raise money.
Again, let's just kind of drill down. What's a bond? A company basically says we could either go to a bank, JP Morgan, well, we don't want to do that. They're going to charge us 8%, or we could issue a bond, and we could float a bond for $10 million, $100 million, and people will scoop it up. We'll guarantee that, 6.5% interest for the next 30 years, and people say, hey, you're AA rated. I'm going to buy your bond because I think you're still going to be paying me in year 29. But now, It gets downgraded. It's a a double B or a junk bond. Sorry, you're going to have to pay
You have to pay more risk.
8.5
Yep.
because I don't know that you're going to be here in year 29. So pay me more. Risk return.
Yep. And that is exactly how these downgrades trickle down into creating additional liquidity issues. Because if banks are borrowing or lending less, businesses can borrow less, individuals can borrow less, whether to buy a home or start a business. That slows down the economy. If we're not starting businesses. And
here we are back to this rolling recession.
Yep.
Okay, got it. Okay, so the other thing that you brought out was inflation. We haven't had inflation for decades. Now, that's another headwind that we have. Now, it's much, much better. And again, this is not a statement as it relates to political, whatever. You gotta give people, you gotta give credit where credit is due. Okay, it peaked at 9.1%. It's now back down to 3%. It's not at 2%. But, as painful as it has been, inflation is getting under control. Fair to say?
it's absolutely fair to say. And I don't know how many individuals are in this camp. I know some individuals love Jay Powell. Other individuals do not like him one bit, or the Fed for what they're doing with interest rates. I do admire and respect the fact that they're hyper-focused on keeping inflation down. Because as painful as high interest rates are, high inflation is a far uglier beast.
It is a cancer in an economy, and we got to get rid of it. So he's given us some chemotherapy. We're, losing our hair, and we might be throwing up, but it's the only thing that they know right now that can cure it. So let's fast forward, okay? What are the two things that we should take a look at as we face what may be a recession, may not be a recession? Forget about it. What should we be thinking about? What are you telling our clients?
It's a great question. Oftentimes, we'll get a call, we'll talk to clients, and investors want to know two things about a recession. When is it going to start? When is it going to end? Because if I know when it starts, I can get out before it starts. And if I know when it ends, I can get in at the bottom. Nobody can do that.
Ain't going to happen, guys.
Not gonna
Don't
happen.
even try.
It's not going to happen. So those are the two questions that are often asked. I would argue that the two questions that should be asked are, how well am I prepared for this recession? How is my liquidity? How secure am I in my job?
Those are the two areas. You got it.
That's it.
Mm-hmm.
That's it. A recession is not an issue unless you have a liquidity issue. I mean, if you're gainfully employed, if you're working through the recession, you're not laid off, you're able to pay your bills, recessions are temporary. You can just endure it.
You may not like it,
Yeah.
but you can live through it, right? That is the most important thing. It's not to avoid it. It is to endure it. And with enough liquidity, an emergency fund, look at worst case scenario, run your own numbers. What if you did get laid off? Would you be okay?
Yep.
In recessions, it tends to, unemployment tends to increase towards the end of it. If you lose your job, chances are it might be harder to find another job because companies, generally speaking, are laying people off. So look at worst case scenario and understand where you stand. Now, if you're really secure, great. I love this one line that you said, when it's all said and done, liquidity is only an issue if you have no income and no reserves.
Yeah.
So, and I also think it's important that, because one of the things that people talk with us a lot about is inflation. And if we have a recession, what's going to happen with, prices and that sort. And I think it's safe to say, and I'm just going to steal your punchline, inflation tends not to go up when we're in a recession. It tends to be, honestly, the cause of a recession because interest rates go up. So the damage from inflation has probably been done, whether you're looking at prices at the food store or clothing or what have you, okay? So in fact, I would say that inflation tends to go down in the midst of a recession because everybody's pulling back, people aren't buying, supply demand, Federal Reserve is lowering interest rates to kind of get us out of it, et cetera. So I would say at this point, I wouldn't worry about inflation quite as much as we may have been. Fair?
Correct.
Okay.
Absolutely.
All right. So now let's talk a little bit about, the impact of recessions, and let's talk about how recessions are more personal. Okay.
Sure.
And Sam, if you don't mind, I think that your story says it all.
Sure.
So let's talk a little bit about that.
Yeah. So it's as I was putting this together, I was saying, rather than asking when is the recession going to start, when is it going to end, we should ask ourselves, what does a recession mean for me, right? And I was looking back, and the two recent recessions that we had, 2020 and 2008, I was looking at those recessions and what they meant for me. And in 2020, I was gainfully employed here. Happily, it was fantastic. So I know it was a horrible year where COVID was concerned. So a lot of bad things happened, but recession-wise, it didn't affect my life necessarily. I go back to 2008. I was just about to graduate college, finance major. So you would think that, wow, that's horrible. You graduated as a finance major during the financial crisis. In hindsight, it was the best thing that could have ever happened to me.
Really?
It was the best because it was a great learning experience. I'm sitting in the safety of a classroom learning about recessions and not having to live through it. I was just able to, and not to mention, a lot of firms were very eager to hire new brokers at very cheap prices during a recession. So I was able to find a job pretty quickly. So that 2008 recession didn't feel like a recession to me. So the more I thought about it, I thought, I have had a recession, but it had nothing to do with the market. And it had more to do with my preparation for in life and financially and liquidity. And back in 2014, today, my wife's name is Sasha. We have 2 kids, Xander and Zoe, and we couldn't be happier. Back in 2014, it was a bit of a different story. So to begin the year, speaking of markets, peaks and troughs, we had our peak. Our son, Xander, was born on March 24th, 2014.
I have chills, Sam. I remember that.
You remember that?
I have I do remember.
And it's like the birth of any child. It's a beautiful, very exciting time. Also very stressful. We had a high deductible health plan. So we had some medical bills that racked up, but we didn't even think about it. We said, you know what? We'll pay it off over time. And look at how beautiful it is. Why should we be worried about medical bills? Fast forward 9 months later. So we're now close to Thanksgiving, and my wife wakes up with a very stiff neck, and she checks, and she has a large bump on her neck. So she goes, she gets it checked out. Several tests, he's hearing different things. After about a month, we finally learned that she was diagnosed with Hodgkin's lymphoma. That was our trough. The market that year went up 14%. I didn't care.
You didn't care.
I didn't care. I had money in my 401k. That didn't make a difference for us. What we needed at that time was support, and we didn't get that from the market. We got that from the individuals that we work with here. A lot of you listening to this right now helped us get through that. You still ask about Sasha. And I can't thank you enough. You guys helped me get through my recession, and it had nothing to do with the market. And we learned very quickly that we have to prepare. So we buckled down, we moved into my parents' basement with our newborn, and we just reassessed. We got through it with the support of loved ones, with the support of Key Financial, and the support of all you out there.
What do you think? I have to pull myself together because I remember that so acutely. When you think about your personal recession, that time, how awful it was. I remember one day saying to you, Sam, work is optional. You do what you need to do for Sasha. I don't care if you never come in. We got your back. And you started to cry, and I cried. It was just such a difficult period of time. So as you think back to that period of time, Sam, what would you say to people listening? What is the biggest takeaway from it?
The biggest takeaway is what's important is the support that we have around us who help us get through and endure these tough situations. We can only control what we can control. We can't control the markets. We can't control illnesses. And ultimately, it was having the support of those around us that got us through that. It was not monetary or market related at that point.
From a practical perspective, what do you think would have made it a little bit easier? I'm going to give you a hint. How about a big fat bank account?
Yeah, gee whiz.
That emergency fund that we all talk about, you know?
I mean, and that is exactly. I'm going back to a previous I did a podcast about you and I did, Patti, about children and finances.
Yep. Mm-hmm.
And I remember going back to how we would pay bills with the family. And that's what we got back to, because, again, we were living in my parents' basement, and I saw my mom at the table doing the bills. And to your point, I was like, we wouldn't be in this situation if we were prepared for this.
So as we've talked about many times before, what we talk about every day, hope for the best, plan for the worst, and run the numbers. And it's different for everybody. So this thing about the economy, the thing about recessions, markets, it is what it is. You're not going to avoid these things. The worst thing that you can do is to try, because there's significant cost in doing so. The key is to endure it. Get through it.
Absolutely.
Whether it be a personal recession or an economic one. Sam, I've pulled myself together. Thank you so much for sharing your story. It's very, it's life, and that's what we do. I think, if I may speak for you, Sam, I think your experience makes you a better advisor. I know the experiences that I've had over my life, whether it's dealing with my parents and what they went through, whether it's dealing with raising 4 children. There must be something about this basement theme, because, Sam, you worked in my basement for many years, right?
Did.
So whatever it might be, the struggles, the adversity, you'll get through it as long as you're surrounded with people who believe in you, someone who can kind of give you that perspective, and most importantly, give you the guidance to tell you, okay, here's the next right thing.
Couldn't agree more.
Thank you all for joining me. This has been a great podcast. Thank you so much for joining me. Thank you so much for sharing that very personal story and taking us back to that time. Do you agree or not? Is he Mr. Relatable or what? And thanks to all of you, by the way, for listening and for watching. Thank you for going to our website and giving us these ideas. Please feel free to continue to do so. We're here for you. Many people come in, they hear a podcast, and they want to brainstorm with us about it. It's free, for crying out loud. It's a great opportunity to have an extra set of unbiased eyes to say, here's how we believe you might be affected by a potential recession. Don't know if it's going to happen. If it does, here's what you want to think about. A, B, C. You walk out. It's wonderful. I love giving people action items. It's a real feel-good, and those people feel fantastic. So thanks again for joining us. Go to our website at keyfinancialinc.com. In the meantime, thanks so much for joining us. Take care. Bye-bye.